Today I'm going to be showing you guys my entire trading plan from start to finish. I'm going to be showing you exactly how I enter, how I manage risk, plan I use to find high probability setups, and then I'm going to backtest or do a simulation session with the plan to show you guys how I actually find these high probability setups on GBPJPY. Stick around to the end. It'll be a long and in-depth video without much editing, more like a course style, completely free. I hope you guys enjoy. So this in front of you really is my entire trading system. In here at the top, we have the general, just sort of a gist of how this system works. We're obviously trading GBP, JPY. We're trading London, New York, and NYSE, which goes from about 1:30 EST is when pre-London begins to about 10:30 EST when NYSE closes. So this is based on New York time. It's the time when there's the most volume for this particular system and pair. So that's when I trade this system. I use 1% as about 10 pips. Okay, so contrary to a lot of trading systems, it doesn't have a set loss per trade. So it depends how big my stop loss is as to how much percentage I risk. So it could either be 10 pips, which is 1%, could be less than that, or it could be all the way up to 30 pips or 3%. So the most I will ever lose in a trade is 3 pips, okay? Another thing to note, which I should add in here, is this system relies on high win rate, okay? In terms of risk to reward, many of you will roll your eyes, but I don't take very high risk to reward. At most, it'll be 1-to-1. Sometimes I have runners, but a lot of the time it's even less than 1-to-1, okay? But the win rate is up around 70 to 75%, including break evens. So, it's hard to believe, but it still works as long as you have a high win rate and you manage your risk really well, okay? And you may be thinking 30 pips, 3% as a stop loss. I rarely take a 30 pip loss. So I manage risk quite often, and you'll see that as we do simulations. Okay, so that is just sort of the general, just to get you guys in the mindset of how this system works. The next thing I want to talk about is entries. So how I actually enter my trades. And this will be the bulk of this section. And don't freak out. It's very simple and nothing that you wouldn't have seen before. So in terms of structure, all we're looking at is support and resistance, higher highs and higher lows. Okay, that is really all we are looking at when I'm talking about structure. When price pushes bullish and then closes bearish at a level, we've rejected a level and created resistance. Okay, so just like over here, we push bullish, we reject that level, we close bearish, we therefore create resistance, okay? Exact same thing on this pullback. We have a bearish candle and then we have a bullish candle, meaning we rejected this level and created support, okay? So exact same thing, we come down, we reject this level and we close bullish to create support. That is a market structure, okay? Same thing in a downtrend. If we're pushing bearish and we reject a level, this time we're creating support. If we then pull back and reject that level again, we create a new resistance, okay? In the process of doing that, we form a higher high and a higher low. Same thing in a downtrend, we form a lower low and a lower high. Okay, so that really is all we need to be thinking about when we're looking at the basics of market structure. Support, resistance, higher highs, higher lows, lower highs. Simple as that. Okay, the next thing we want to look at is breakouts. Now, goes hand in hand with market structure. I'm sure you guys know exactly what a breakout is. It's simply price creating a resistance or a support, pushing back, and then breaking out from that level. Okay. So if price closes above a resistance, we have a bullish breakout. Simple as that. We need a candle closure and we have a breakout. Same thing if we are going bearish, we create support, we break through that support, and we have a bearish breakout. Okay, very simple, nothing too crazy. It could also be that price is in a range, it has support and resistance, it fakes out a couple of times, and then you get a nice breakout like that. Exact same thing, okay? And we'll talk about how we can identify fake outs, and exact same thing could be something like this, and then it breaks out to the top. Exact same thing, you have an area of support, resistance, and it breaks out from that level, okay? That's all we're looking at when we're talking about breakouts. So we have structure, we have breakouts. The next thing I want to look at is clean range, okay? Now, this is very simple. This is simply what are we looking at when price is broken out to the left, okay? So let's say we have a bullish breakout. We want to be looking at what's going on to the left here in this range, okay? So in this range where price is just broken out, we want to see what is happening to the left, okay? And clean range is areas in the market where there's no obstruction. So previously, price pushed really nicely and cleanly in this level, and there's not going to be support and resistance in this area, okay? The reason we look for that is so that when price breaks out, there's a good chance it'll replicate what it did before and push with volume through that range to fill that level to the nearest resistance. Okay, so let's have a look at a example just to make it a bit more clear. Okay, if we, let me just find one. Okay, so let's look here. So what can we see here is we have a level of support that's formed right there, and then we have a level of resistance that's formed right there by this candle closing bearish. Next thing that happens, if we zoom in a little, price breaks out from that level. I'll put a line so it's a bit more clear. And what do we have to the left? We have clean range, 21 pips. Okay, so that means there's a good chance that price is going to push up to fill this range. And it does. Okay, doesn't mean it's always going to happen. It's just one of those things that increases the chance of us taking a high probability trade. Whereas if we're taking a trade, let me look again what's happening here. Find a good example. If we're taking a trade, let's say here, okay? So we have a breakout from this resistance, and to the left, we have a big resistance, okay? There's a good chance price is only going to push and fill up to this range. It's going to see some traffic to the left, okay? So we don't want to be trading into these areas of high traffic. We want to be trading into areas where the market has moved very nicely in the past, and often it will replicate it. I urge you guys to just look at GBPJPY especially, and gold as well. Look at areas where there's been clean range to the left, and often price replicates how it's moved in the past in those areas. Okay, so for me, clean range, it has to be above, let me put that in brackets, plus 20 pips of clean range. Okay, so if we have 20 pips of clean range, it means we're good to take a trade on that breakout. Okay, so hopefully that's not too confusing. Okay, next thing is range 1, range 2. So if we're looking at this, range 1, range 2. Now, this is a very simple rule. All it is that if we're looking at the daily, okay, so let's move all this around. If we're looking at the daily, okay, if yesterday closed bullish, what are the chances today is going to close bullish? If you had a gun pointed to your head and you had to take a trade and all you could see was how yesterday closed, you take bearish or bullish depending on how yesterday closed. Okay, so if you saw this big red candle and you had to take a trade, you take a sell. It makes sense. It's the only reasonable option. Okay, there's a much higher chance price is going to close bullish than it is going to close bearish if yesterday closed bullish. Okay, so range 1, range 2 simply states that if yesterday closed bearish and today we're taking a sell, we only need one range to break out of. But if yesterday closed bearish and we're taking a buy, we need two ranges to break out of. Okay, so let's say for a bit of an example here. Okay, so yesterday closed bearish. Okay, and today looking at buys. Okay, so yesterday closed bearish and today we're looking at buys. Nothing wrong with that. It happens all the time. What we want to see is from the Asia session close, which is at 9:30. Let me put this in 24-hour time. 9:30 is 21:30 EST. Okay, so let's say this is Asia session close, essentially. Not close, it's past the open. Okay, so after that Asia time, I want to see price create a range, break out of that range, and often price will fake out, and then we want to see a new range and a new breakout. So we have two ranges that we've broken out of. There's your range 1, there's your range 2. Okay, so you have support, resistance, you break out, you fake out. You have support, resistance, you break out, and now you're good to take a trade because you've had one range and two range breakout. Okay, if we are looking at sells, we're trading with the overall bias of the market, so we only need one range breakout. So let's say we get to our trading time and we break out of this level, we're good to take sells. Okay, we've had one range, support, resistance, we break out, we're good to take a trade. Okay, this may be confusing now, but as we do the simulation, it'll become very clear. And you'll actually see that a lot of the times when we're looking to take buys or sells and we're going against the bias of yesterday, price fakes out. Okay, it often comes back, grabs liquidity before pushing up. Because if we look at the daily, what we're trying to catch when we are taking a trade against the overall bias of the market is essentially this top wick. Okay, that's what we're trying to catch. So we're not going to try to catch these huge trades to the upside. Price will often sort of struggle around here. It may fake out a few times and then it will push to the top. Okay, and again, this is one of those rules that it's there to eliminate bad trades. It's not there to capture every single move and make everything perfect. It's there to simplify the process. It's there to identify fake outs and help us trade easier. Okay, it's not just always gonna work perfectly. Okay, the next thing we want to look at is wicks and liquidity. Now, let's go back to our idea of price breaking out from a level. Okay, so we have a breakout and price is closed above resistance. Very rarely will price just push. Okay, very rarely. Often it will first come back. It may come back a lot to grab liquidity, or it may just come back a little bit before continuing bullish. Okay, now if we look at price in terms of a different perspective and we look in terms of candles. Okay, so let's say we have a bullish candle right here closing at that resistance. We have a wick, then we have a bearish candle to create that resistance, and then we push bullish to create the breakout. Okay, so you can see high, 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 low, breakout. Exact same thing. What is this retest going to look like if we're looking at a higher time frame? So let's say this is on the 5-minute and this is on the 15 or 30-minute. Okay, essentially it's just going to look like price opening. It's going to come down to create a wick. It may grab some lows. It may continue all the way down, but if it's a true breakout, it'll flip eventually and close bullish to create that continuation. And what the actual candle is going to look like is it's going to have a wick down here to show price pushing down to create that retest. Okay, so our entry when we're using this system is going to be either at the break of that previous high right there, so the break of that high, or it's going to be at the flip of this candle right here. So if price comes down and creates a wick, we're going to flip and we're going to enter. And if this wick is big enough, we can potentially see a wick fill to fill that wick. Okay? Because essentially we've come up, that previous wick was a higher high, price pushed down. What's price likely going to do? It's going to push up to come and retest that previous higher high. Okay. Now, this may seem a bit weird, but it's very simple and it'll keep getting more simple as you practice it. In terms of liquidity, I don't like to focus too much on it. I like to focus more on sort of what price is doing, but it is true. Price very often will come down and grab lows before continuing bullish. Okay. Very rarely before a big move will price not grab liquidity. It'll very often grab liquidity, and using Wicks, we can still see that quite easily. So we don't have to sort of mark the lows and figure out where price has gone. But it could even be that before this breakout, price does something like that and it grabbed liquidity before, grabbed these lows, and then it just comes back for a little retest to retest that area. Okay, that's a very common sort of pattern, and how that'll look is simply sort of like this. We have a wick down. So there's your candle. Then you have a bearish close that could potentially grab lows. Let me just make this a bit bigger. Could potentially grab lows. Then you have the breakout, and then price goes on from there. Okay, and you'll see that wick down, and our entry will be somewhere around here to grab these highs. Okay, I understand this may seem confusing just looking at it in sort of my terrible old drawings, but it will become more clear as you practice and as you backtest and trade and sample size in the last live markets. Okay, so the last thing is break of high or low plus wick fills. I sort of talked about that here, but this is our entry point. So we're either going to enter, let's say this is a breakout candle. Let me make this a bit smaller. So let's say this is our breakout candle. Here is our resistance. So broke out from this level. We are going to enter as price breaks that high. Okay. If we have such a small wick, we're going to enter as price breaks that high. So our entry will be something like this. And we usually have stops sort of, I forgot to talk about stops, but we will talk about stops right now. Our stops will either be at the low of the current candle, or it will be at the low of the previous candle, depending on how big it is. So let's say the stop to the previous candle is less than 30 pips. Then we can use that previous candle as a stop. If the stop of the previous candle is bigger than 30 pips, we'll use the current candle as our stop loss. Okay, so that's just simply to see and manage risk. Okay, the other scenario is a wick fill, which is when price closes like this and it has a wick that is sort of greater than 5-ish pips, and we can look to enter. So let's say price opens, it creates a wick, we can enter on the flip to catch that wick. So our entry will look something like this at the flip, and we'll be looking to target these highs. Okay, very simple, and I'll continue to explain all this as we go along. So that's our entries, and hopefully that makes sort of sense. I will go through more of them as we do our simulations. Some other notes: quality over quantity. You guys will see this when I'm backtesting. I don't take very many trades. Okay, most days are no trades. Okay, so you need a lot of patience to trade this system, like all systems, I think, and you need to backtest to see that when you're trading in the live markets, it's okay to not have many trading days. Okay, I take less than 10 trades a month and we still get very good return. Okay, it's not about how many trades you take, it's about how good the trades are that you take. I promise you that, especially with this system. Okay, some other things is you guys can play around with your TP. Okay, I generally use support and resistance to the left and noise to take my TP, I often take partials, and you'll see that as we go along, and I'll talk about break even as well as we do the sim. The next thing is volume plus range equals runners. Okay, so this is one of those things that you get from trading the same thing, the same pair, the same system for a long time, is you start to understand when the big moves happen. Okay, so usually post news, when big world events happen, there is a lot of volume in the market, and it often creates lots of clean range. So when we're talking about range, when we have lots and lots of clean range on a breakout, and we also have lots and lots of volume, and I'll also add usually liquidity taken. Okay, so when there's been a big liquidity grab, when prices pulled back and stopped out a lot of sort of retail traders, I guess you could say, but we're all retail traders, and then it flips and pushes bullish, and you have volume and you have range, there's a very good chance you're going to see some big moves. And I usually am patient with my TP, and I trail my stops, and I get much bigger take profits. Okay, so please feel free to ask any questions, but I'm sure they will be cleared up as we do the sim. And I know it's a lot, but ultimately this is a full trading system, so you may have to watch it through a few times, and you definitely have to actually backtest it and use it in the live markets yourself. Okay, I've been trading this for 12 months, almost longer, every single day for 2 sessions. Okay, so you know, there may be some things that I'm not explaining as clearly as I should, because they just sort of are ingrained in my mind. Okay, so you can't expect to sort of get this straight away. It is very simple, but you need to do your own simulations, figure out exactly how you want to trade it, because obviously we're going to interpret price differently, but this is a very good system, and you just have to be patient and learn as you go. So let's do the sim. So I just realized it'll take a very long time to do a simulation as well in the same video, so I will do that in the next part. But for now, you guys can look at some of my older trade reviews for some real examples, and I also have some older simulation sessions. Hope you guys enjoyed, and stay tuned for part 2.